Good morning and welcome to this Wednesday, September 22nd, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we've got futures rebounding again this morning. Of course, we had a horrible day on Monday, and then yesterday opened up pretty solid, sold off late in the day, and today we're going to get another shot. We have the Fed coming out with their latest policy statement at 2 p.m. today. That's going to obviously have a big impact on the market. I'm going to talk a little bit about that. I wrote an article in my Trading Places blog yesterday about the last 10 Fed meetings. I went back and just did a little research on how the market performed the day that the day that the policy statement was released. So from 2 o'clock to 4 o'clock that day, and then also over the course of the following week. I thought it was kind of interesting. Quite honestly, I thought the market was much more volatile. My recollection is that, we see a lot more volatility after the Fed meeting than was actually the case. So anyway, I want to go through and talk about that a little bit. We're going to get into all of that in just a moment. I do want to take everybody over to earningsbeats.com. Get us set up here. So for those of you who are new, welcome. Certainly appreciate you coming over to support us here at Earnings Beats. If you don't already know, I do a show also Tuesdays and Thursdays at Stock Charts on Stock Charts TV. Both those shows also start at 9 a.m. Eastern. So if you just come in here on Monday and Wednesday and you're not aware, Tuesday and Thursday, I also have Trading Places Live. The only thing there is that at this point, it's really not live on Tuesday and Thursdays. I'm doing recorded shows. Should be getting back to live shows probably the beginning of next year, but I'll have more on that later. If you are new to Earnings Beats, love to have you come over to our site, earningsbeats.com. Just scroll down. Got a free newsletter, Earnings Beats Digest. Sign up, name, email address, hit the subscribe button. It's free. No credit card required. You can unsubscribe at any time. You won't hurt my feelings. Honestly, it's really just an opportunity for us to reach out to folks, let them know how we look at the market at Earnings Beats, some of the things that we look at, relative strength, earnings related gaps, some of the things that I enjoy trading off of, and do a lot of research based on that. But anyhow, you can sign up there with your name, email address. We'd love to have you. Moving on to the action on Tuesday. So you can see on the Dow how we had gotten up quite a bit intraday, but then came back down and closed down near the low of the day, or almost right on the low of the day. Dow Jones finished down 51 points on Tuesday, and that was after a big sell-off on Monday. Of course, we had recovered some in the afternoon on Monday, but still, the overall direction right now in the market clearly is down. I think you can see that here in September. I think we're into an area where we're likely to find some support. I don't know, maybe we go down and sometimes you'll see a tail, an intraday move, go down below some key lows and then come back up, figuring a lot of times market makers, if they're trying to accumulate shares, if you get a false breakdown, there's not too many technical traders I know that will buy a breakdown. They normally will wait and see if if that breakdown is temporary. So the only folks that will be buying a breakdown, in my opinion, at least in volume, would be market makers. So we want to watch these support levels and see if they're taking out an intraday basis and then a recovery. We could almost look at the Dow and compare it to the July low. And you can see we already did take out that level and then rebounded above it. If you look at the S&P 500, yesterday we're down 3.5 points, but we went down below the August low and now maybe that's the false breakdown. What we see here over the course of the next couple of days to a couple of weeks is going to tell us whether or not we have established a big support. It could be. Talked many times about the volatility index, the VIX, and how important that is in terms of marking bottoms in secular bull markets. Many times I see it right around that 30 area, maybe as high as 35. On Monday, when we went down and hit that low, the VIX went up to 28.79. So we got up almost 29, pretty close to that 30 level. I'm not saying the selling is over. We got the rest of this week, which historically is bearish. We got to get through that. Got the Fed, later today. Who knows what they're going to say? I think they tend to support equity prices. They normally don't want to, upset the apple cart, if you will. So I think that they're going to come and go without a whole lot of fanfare, but doesn't mean we won't still see a couple more days of selling. We'll have to see how this pans out here over the next couple of days. But anyway, the S&P 500 down 3.5 yesterday. NASDAQ plus 32. It was down off of its earlier highs. Saw a lot of selling into the close, but still up 32 points yesterday. So we did rally off that Monday selling. Mid caps, though, down 4, small caps down 2. So they both did finish in negative territory. And across the board, all these indices, you can see September has been so far a fairly rough month, but that is not unusual. We know September is the weakest month of the year. Energy leading the market higher to the upside after a rough day on Monday. We did bounce back about 0.25% to the upside. The groups that were up yesterday, there were 5 sectors up, but energy at 0.23% was the best performer. So obviously there wasn't a whole lot of gains to be had yesterday. Industrials, the leader to the downside, losing about 0.5%. So 5 sectors up, 6 sectors down, but overall there wasn't a whole lot of difference between the top and the bottom. It's just kind of a flat day in the market. Communication services also down. They were down about 0.4%, and they have lost their 50-day moving average, which you can see hadn't done very often here over the past 6 months or so. The travel and tourism, I wrote about this in Daily Market Report to members yesterday. I like what's happening here, but you still have to keep your guard up. I don't know if you've seen the gambling index. I mean, a week or two ago, I would have sworn gambling index was off and running back to the upside. And this is what's been so difficult about trading the market this year is you get what you think is a great breakout, some kind of breakout recovery. And then all of a sudden it's gone and carpet's pulled out from under you and then you're back in a downtrend again. So strength, even on an absolute basis, seems to only last a short period of time before we roll back over in many of these areas. But it's still worthwhile noting travel and tourism making a big breakout off of this downtrend line. I think from a longer term perspective, it's a breakout of a bullish wedge. Travel and tourism was very strong up until about April of this year. And then when May kind of came in, we saw a lot of the stocks getting hit in May. Travel and tourism, you can see, took a big hit. But big volume yesterday. We did see a big recovery. We'll see whether or not this holds on travel and tourism. The last group I'll talk about here, aluminum. I don't know if you recall, I wrote an article probably a month ago, and I said, get out of 2 industry groups now. Well, I was right on one and I was wrong on one. I was right on steel. Steel has not been good over the last month. Aluminum, however, and I think I wrote it sometime around the middle part of August. I'd have to go look. I think we were already starting to go down some. Maybe we had already taken a big plunge. But aluminum came roaring back. Well, yesterday it was down almost 6%. I still think this chart from a weekly perspective looks incredibly bearish. I'd be very, very careful with the aluminum group, especially seeing the selling picking up on volume, moving down below the 20-day. We'll see what happens from here. But aluminum having a rough day, or having had a rough day on Tuesday. All right, 10-year Treasury yield. Let's get an update here, talk a little bit about what's going on with the economic reports. Later today, we've had a couple of housing reports out this week. We're going to get another one out this morning. Existing home sales will be out later this morning. The expectation for August, 5.9 million units. July was 5.99 million units, so 5,990,000 units. So we're looking for a little bit of a drop there in the existing home sales. Currently, we got the 10-year Treasury yield completely flat, and we're just going sideways. I don't really have a whole lot to say about 10-year Treasury yield right now, except we're going sideways. I believe that the economy will continue to strengthen, and signs will continue to point to further strengthening. So I believe we're going to get a breakout on the 10-year Treasury yield to the upside. And I think it's going to be economy related, not inflation related. But we'll see how this all pans out. 10-year Treasury yield, though, currently sideways consolidating. A break above 140 should be respected. All right, moving on to talking technically. I want to talk about the transports because, we talk about economic strength. You certainly expect transports to go higher. I've written a ton about this. This is continues to be one of the things that keeps me up at night. If I worry about anything in the market right now, I would say it's primarily transportation stocks. We don't normally see this kind of divergence between what the S&P 500 does and what the transports do. I mean, over a 5-month period, and I showed a correlation, and I can do it again here. Let me pull this up down here. If we look at the correlation between the transports and the S&P 500 over the last, well, this would be 20 days. I'm going to pull it up over weeks on a weekly chart. And let's go back 20 years. I mean, we could go back 50 years. We have never seen correlation as inverse between transports and the S&P 500 over a roughly 5-month period. 20 weeks is roughly 5, well, maybe 4.5 months. And we could go back even further. I mean, I can take this back, 50 years. And I want you to look at the correlation. First of all, rarely do we see inverse correlation, even on a weekly chart. Monthly is very rare because that goes back 20 months. But on a weekly chart, going back 20 weeks, I mean, for the most part, transports and the S&P 500 go hand in hand. If transports are doing well, the S&P should do well. And if the transports aren't doing well, you would think that would lead to a not so good performance in the S&P 500. So it makes sense to me that we spend almost all this time in positive correlation territory. But you can see there are periods where the two go opposite over this 4.5-5-month period. And we are in the biggest period of inverse correlation in the last 5 decades. I mean, I don't know if it'll let me go back 100 years. Let's see how far this goes. All right, so this goes all the way back in the 1920s. Right now, the inverse correlation is the worst it's ever been in 100 years. Now, maybe this has something to do with the 100-year pandemic. We hadn't had a pandemic in 100 years. We all know the market's been crazy. I mean, it's been up and down. Various groups are leading, then they're lagging, then they're leading again, then they're lagging. I mean, the bubbles going through the market, short-term bubbles. I don't think we have long-term bubbles. But I think, the supply chain disruption, all of a sudden inflation taking off. Now the last report, inflation was a little bit more tame. It's been crazy everywhere. So when I look at this and I say, well, it's the biggest inverse correlation between transports and S&P 500 for 100, over the last 100 years, I think maybe it's just the pandemic. Maybe I don't have an explanation for you, to be honest. I do know one thing. You got to be careful because this is a sign. I mean, transports, if the economy is going to strengthen, transports should be doing well. Now, you've got to keep a couple things in mind. Number one, we had a massive move in transports before this pullback. So when you look at just the last 5 months, you're like, what's going on? What's wrong with transports? The stock market must be ready for a crash, with transports doing so poorly. But, if we go back, let's just go back the last 3 years and look at what happened prior to this pullback. Does this look bad on this chart after seeing transports go from 6,500 to 16,000 in 14 months? I mean, we can't keep going up that pace, can we? It's this rotation that we keep going through. One group explodes, and then all of a sudden they can't catch a bid. We saw it last year with many of the technology names, consumer discretionary names. We got to about February of this year, and they all fell apart. But now many of them have come roaring back. So don't write off transports because they're down for 4 months. I think that would be a big mistake. In fact, I would have no problem personally building, if you're somebody who likes to build positions over a period of time, on weakness, I would be building position in transports. I think transports are going to rally back. Is it going to be next week, next month, next quarter, next year? I couldn't tell you. But I do like the overall pattern. I think we're going through a period of consolidation, rotation, call it what you want. And I think we'll be back. Transports, weekly PPOs back down near the center line. So I think a lot of this is just overblown, and I believe transports will come roaring back. I do want to just point out again, though, that if you're looking at this chart, the weekly, we see a lot of inverse correlation. But if I switch it to monthly over the last 100 years, look at where we are. We have positive correlation. the S&P's been flying. Transports have been flying. It's just the last 4 months, and that's not going, or 5 months, and that's not going to change correlation over the last 20 months. This is looking at 20 periods, monthly chart, 20 months. So big picture, I'm fine with what's going on in transports. Short term, it's keeping me up at night. And I want to see the transport start to rally. If we see that, I think that would be the biggest signal that this rally is not over, that the secular bull market is likely to tack on, even stronger legs in the fourth quarter. All right, just kind of continuing with the same theme here with transports. Here's the IYT. Here's your downtrend. I want to tell you which, and I'm going to pull up the charts of the stocks that make up 71% of the IYT. There are 10 of them, starting with UNP. So you got United Pacific. Here's one chart. Look at what's going on here, selling off. How about UPS? UPS been holding the support, but after FedEx's earnings last night, UPS, last time I looked, was down $4 pre-market, $3 or $4. Maybe, I don't know if it's $4, 4%. Actually, I think it was just $4. I don't think it was 4%. But anyway, we're down into this gap support area now. I mean, we went through the top of gap support. So this is opening up for me, in my mind, UPS to move back down to about 175 to 180 based on the open. Now, maybe we'll get a hollow candle and mark a bottom, but the fact that we've broken down or that we're about to break down tells me UPS could be in for further selling. How about CSX? So by the way, UNP 17% of the IYT, UPS 16% of the IYT. Then you've got CSX Corp, a railroad, 8.7%. It's at a multi-month low. FedEx, which I just talked about, reporting earnings. I'll talk about the earnings in just a couple minutes. FedEx 4.5%. It's been going down. The stock was getting hit pretty hard. Pre-market down 6%. So that's down, what, $15. We're going to be down to about 237. We're probably very close to this low down here. And honestly, unless we open up beneath 233.49, I think we're probably going to be in a bottoming phase on FedEx. I think with this earnings, we probably will bottom. That's just my educated guess there. NSC, Norfolk Southern, is 4.47% going down. Now, Uber just got some good news. They raised their guidance, and you can see a big move up on heavy volume. So here was one that was in a downtrend, but actually starting to move back up. This is 4.2% of the IYT. Southwest Airlines, downtrending. This is 4.11%. ODFL, truckers actually have been doing pretty well. Old Dominion doing pretty well is also 3.99%. So it's not really that well represented. And then you've got Delta Airlines, 3.98%. And then Kansas City Southern, KSU, this is another 3.8%. So just those stocks I gave you, those 10 stocks, 71% of the IYT. So if you're wondering why the IYT just keeps going lower, it's because 8 out of those 10 stocks, in my opinion, are continue to be on a sell signal. Uber made a nice breakout yesterday, and I think Old Dominion looks pretty good. Other than that, all these other stocks, and I would have said UPS down at support in the short term, 188, 189, good support. That's going to be lost today at the open. So 8 of the 10 stocks make up 71% of the IYT are clearly downtrending. So until that begins to change, IYT is not going up if its component stocks continue to weaken. All right. So the article I wanted to just go over briefly with you. This is the article I wrote yesterday talking about the Fed meeting, the last 10 Fed meetings. So I don't know if you understand. I mean, I love doing spreadsheets. A lot of folks, their eyes roll back in the back of their head when they start seeing numbers in spreadsheets. That, it's better on charts. But here, all I was doing was I was just looking at where the S&P 500 was at 2 p.m. the day of the announcement. So just like today at 2 p.m., where is the S&P 500 going to be? From there, I looked at the day of the announcement from 2 to 4 o'clock. So just over those next 2 hours, what was the high, what was the low, and what was the close? And then I looked over the next 5 days after the announcement. So 5 full days. What was the high? What was the low? Where did we close 5 days later? So here were all the numbers, but if you scroll down, I did it in percentages. So now you can at least look and say, okay, a week after the announcement, the last 10 Fed announcements, here is where we stood, 5 days later. Now, I think it's also important to see that on 9 of these announcements, 9 out of 10, the Fed meeting occurred in the second half of the calendar month. Second half of calendar months tend to be more bearish than the first half. So we're already getting a report in a half of the month when the market tends to be weaker. So I think you got to take that into account. But if you look at this, the low 1 week, or at least at some point after the announcement, 8 of the last 10 Fed meetings, the S&P 500 has gone down at least 1% from the time of the announcement over the course of the next 5 days. And you can see a couple of these days, it was a lot more, 2.4%, 5.3%. The average drop was 1.8%. The average gain over the next 5 days, the average high went up about 1.5%. So it looks to me like things are skewed a little bit more to the downside. And I don't know that it's because of the Fed. I just think it's because we're in the second half of the month more than anything else. So I think the Fed's going to do what the market believes it's going to do, which continues to support U.S. equities. If you're waiting for the Fed to come out and say the stock market's overpriced, I don't think you're going to see that. And if you're waiting for the Fed to say something that is going to take down the stock market, I just don't think it's going to happen. I think the Fed is going to tell us in advance, well in advance, their tapering plans. I don't think they're ready to start tapering yet. If they are, that probably will send a shockwave through the market. Just initially. I mean, we all know it's coming at some point. You can't keep buying these bonds forever. So we know it's coming, but the initial shock, it's going to be like that sticker shock. When you first see it, I think the market is not going to like it. But, we've already built some of that in. So it's really hard to say with the S&P already down in September, what kind of impact we might see here with the Fed announcement today. The other thing I did in this article is I did a chart and I put the Fed announcement dates. This is kind of approximate. I had to approximate based on the dates that I have up here. These vertical black dotted lines right here are all marking dates of when the Fed met. And when I look across here, I mean, let's just start here. We were rising into the Fed meeting. Then we went sideways to down. We were rising into the Fed meeting. Then we went down. We were rising into the Fed meeting. Had some volatility, but initially went down. We were rising into the Fed meeting. We went down. We were rising into the Fed meeting. We went down. I mean, I'm starting to sound like a broken record here. With the exception of, I would say, last September, which looked very similar to what we're doing right now. We went down heading into the Fed meeting. We're going down heading into the Fed meeting. And the market kept going lower before we marked a pretty important bottom. The other thing I would say is that historically, the low that you really want to watch for is October 27th close. And so end of September, we tend to do well heading toward the start of earnings season, which we did last year. But once earnings start coming out, October 21st to the 27th, right now we're in the second worst week of the year historically, September 20th to September 26th, the second worst week. The first week is October 21st to the 27th. So when we get through that period, that tends to be a bottoming signal for the market historically. And we tend to go up from there through about the middle part of January. 60 of the last 71 years. That's a pretty high percentage. 60 of the last 71 years. The S&P 500 has been higher on January 18th than it was on October 27th. So we've got that coming down the road. So right now, this is kind of a period where you got to be a little careful Then the market tends to be bullish heading into October. Then I think you got to be careful again as you work your way through the balance of October. And then November is an extremely bullish month. If you want to see what November has been doing, let's pull up seasonality. And pull this up. All right, so the last 5 years, November's been up every year. Let's just pull it back. Last 6 years, up every year. 7 years, still 100%. 8 years, still 100. 9 years, 10 years. It's the only month that's been up every time for the last 10 years. Finally, 11 years ago, it went down. But I mean, if you go back over the last 20 years, you can see April and November have been, that's the highest chance of any month that you're going to end the month higher than you began. And if you look at it, on a absolute average gain basis, November 1.9% only trails April's 2.4%. So as we get through September, you can see things start to pick up October, November, and then even into December, January, all the way through April. All right, let's move on. I wanted to talk a little bit about earnings. So Adobe came out, they beat on their top line, they beat on their bottom line, $3.11 versus $3. The stock's down 3.6% pre-market. So, I mean, we're talking about probably $20 or something, maybe $23. So we're going to be down around the 620, 622 area, something like that, based on the last reading I saw. This was probably 30 minutes ago. But we are pulling back. I think Adobe's awesome. I think we'll definitely find a bottom at some, well, I shouldn't say definitely, but I believe Adobe will find a bottom. But got to get through this earnings reaction. It may last for a few days, maybe even a week or two. But I think heading back into October, you're going to see Adobe start to pick back up again. Fedex, as I mentioned, Fedex reported last night. The news was not good. They beat on their top line, but bottom line, they were expecting 496. They came in at 437. It's a big miss. We haven't seen too many big misses in the market, but FedEx had a big miss on their bottom line, which is why you're going to see it open down $15 today, roughly. Stitch Fix. This actually was a great report. Blew away revenues. Expected to lose 14 cents. They actually posted a gain of 19 cents. And the stock is up 11.59% pre-market. So that'd be somewhere around $4, a little over $4, maybe 40-ish, something like that. So maybe just over the 20-day. AD line hasn't been great though. So when I look at that, and if I was in the stock, which I would not have been heading into earnings anyway, the way it was trading, but if I was and I got the gap up, I'd take the money and run, just based on everything else I see on the chart. Now maybe Stitch Fix will gap up and continue going higher and become a great turnaround story. That would be great, but I'd have to see it. I would not just expect it's going to happen. General Mills also reported. They reported this morning. Pretty good report. Beat on top line, beat bottom line, 99 cents versus 88 cents. Stock up 3% pre-market. So it's going to be up, I don't know, maybe about $1.80, which would take it up to about 59.80, up into this area in here. Still not out of the woods, though. I mean, still in this downtrend. AD line's weak. I'd look elsewhere. Finally, the three you must see. I'm going to start off with MXL. MXL, this is a stock I mentioned in our Earnings Beats Digest this morning. I just think, if the market gets overdone to the downside, I'm looking for stocks like MXL, which is a leader. So if we pull up the relative chart, I mean, it's been performing extremely well versus the S&P versus the semiconductors. Semiconductors have been pretty strong versus the S&P. So I got a leading stock in a good group. If this were to break down below the 50 and get back close to gap support near 44.5 or so, I would be all over the stock personally. I mean, that's what I would be looking for. So that's what, when I'm in a bad period, I just start looking for stocks I want to own and think about building positions during weakness. Nike has been pulling back, but it already got back to its key support area around 152, 153. Maybe it works down to 150 to test this area, but I think we're getting close to a bottom on Nike. And then the last one I'll mention here is Disney. Disney selling off on big volume, but it has been holding this area of support between about 160 and 170, multiple occasions. That's where we finished yesterday. Gap support's all the way down at about 155. So maybe give it a little bit more room, but I think this is just a long period of consolidation and Disney heads higher. All right, market just opened. I've been trying to end these shows just before the market opens, so I'm just a few seconds late here. Right now, we got the NASDAQ up 55, Dow up 183, S&P up 22. Remember, Fed meeting today, 2 o'clock policy statement, and everybody's going to be picking apart the words. Just keep in mind the history. Probably going to see a little knee-jerk reaction up, down, back and forth, but it'll settle down, and I would suspect over the next 5 days, we'll have an opportunity to get some of these stocks a little bit cheaper, in my opinion. All right, everybody have a great day. I'll be back tomorrow over at Stock Charts TV at 9 a.m. Eastern for the next Trading Places Live, though it will be a recorded show. Have a great day, everybody. See you tomorrow. Happy trading.